All right, everybody, here we go. Stocks by the numbers. Welcome back. I know it's been a rough couple of days as we see, even looking at something like SoFi, SOFI here on the NASDAQ, 1163 after hours down to 1158. And the last time we looked at it was right about here, I believe, about a week ago or so. And we were looking at the potential run up back to this top trend line here of about 14 and a half. And you can see right here the high of the day, top left of the screen, 1390. And look at this fib right here. There's a 1-year chart, by the way. 1-year top fib, 1390. So the stock ran up exactly to 1390. Market started to turn red, get a little volatile. That's where the rejection happened. And you can see the pullback basically back to the bottom of this original channel, almost back to the previous bottoms there of slightly sub 11. And then we had a little bit of a bounce. Even if you look at the day today, you can see we opened up, we dropped down again to just slightly sub 11, and then we had a bounce, and look at that climb steadily throughout the rest of the afternoon. So unfortunately, in theory, what I have to say here, overall, when we look at these stocks that have done well for us, as we see in the past, we look at stocks like SoFi, stocks like HIMS and HERS, maybe something like DraftKings, right? We were in the 2030s, then we ran up to the 40s, the 50s, and now everything is cooling off, everything is pulling back. And this is basically my original main concern that I used to cite, like a year and a half ago, pretty much throughout every video, right? Markets were up 50% under Biden when a lot of people were clamoring that the economy was not performing as well as the markets were. And now you bring somebody like Trump in, and supposedly in theory, as we said, he's trying to do things that would technically be good for our major indices. However, we know in theory, as the dollar gets stronger, technically stocks pull back. We can see during this volatile time, you can see a lot of money shifting into bonds. You can see a lot of money shifting into commodities. Things like gold, silver have been holding up very well. Something like oil, I mentioned previously in the Discord. Again, Discord free for you guys to join. Just request a link in the comments. But I've been talking about oil again as well, as you see. I was looking at this key level of 67.5. This was the original projection laid out that worked out to a T. And then you can see how it was bouncing off this trend line and hanging out and trying to hold that 67.5 per barrel. Then when we had this big green candle, we got back above the 20-day moving average. That's when I mentioned in the Discord that, in my opinion, I would consider USO calls. I think I might have tweeted it also on X maybe, but I said, in my opinion, back to the next trend line of about 73.5 roughly per barrel. And you can see that we got up above 68 and now we're at 71 and a third, 3.4% move today on oil. So this is why I say also, there's nothing wrong with, taking a sizable position in a spec grower, something like an ASTS or a Rocket Lab. There's nothing wrong with taking a position in these growth stocks that we've seen perform well for us. Again, SoFi, excellent example here, right? Over time, it's probably going to work out well. But if markets keep getting smacked up, SoFi could definitely give back some of its gains. You can see 10, you can see 9, and then you can potentially have that bounce where it kind of quote unquote bottoms out, right? But I've been saying and speculating, in my opinion, that the first year under Trump, markets were actually going to go down, even though on paper, it seems like a lot of good things are being done for our industries, right? Our factories, our manufacturing. But again, it does seem like a lot of people are taking those hedge positions. So that's why I always say, in my opinion, don't be afraid to diversify and don't be afraid to have hedge positions. Whether it's metals, whether it's oil, whether it's a bond fund, whether it's just buying the VIX. Again, I always used to say that. If markets are volatile, stocks look good, you don't know what to buy, just buy the VIX. Just buy the VIX. And you guys see that when markets chunk down, 400 or 500 points and we have a big red day, the VIX shoots up like 15%. Right? So that's why, again, there are certain ways to protect yourself and even potentially make money while the other positions are, in theory, on paper in the account, losing value. But even something like HIMS and HERS, again, I just have a feeling that we're breaking first resistance and we're pulling everything back to bottom resistance levels. Even something like DraftKings we'll look at in a second. But HIMS and HERS, HIMS, right? 29.55 up 41 cents today, 1.4%. After hours down about 0.5%. But you can see I was looking personally for a bounce off of this trend line here. Looks like about 33 in change. And you can see we had a big red candle drop essentially right to the trend line. But you can see how we were closing below that trend line. And then, obviously, markets continued to remain volatile, so we ended up breaking down as opposed to bouncing and showing some strength off the trend line. So it seems like, one, a lot of these nice growers that we saw over the last year or two are coming back down to reality. And two, it seems like they're all retesting those bottom support trend lines. I'm sorry, I was going to say something else, but I lost my train of thought. But long story short, if we do happen to pull back to this bottom trend line now on something like HIMS, you see we're looking at about potentially about 24 1/3. Right? So again, in general, something like SoFi, long term, in my opinion, I have a personal price target of like $25 a share, I think, right now, conservatively. So something like that, if you do have consistent income, if you're able to add to the position, lower the cost basis, I personally think long term, in my opinion, something like SoFi should be fine. Same thing with HIMS and HERS. HIMS, the revenue, we were looking at it, I got a virus. The market cap here at $6.5 billion, but again, we can see the growth in revenue, the growth in profits over the quarters, over the years, right? These are the types of stocks, in my opinion, that you want to keep on your watch list. And when they do have these big drop downs, these big sell-offs, that's when you can step in and you can start to build a position, accumulate shares, and buy that dip. But again, this trend line here, just to point out on HIMS, the bottom of October 30th, 2023, coming up to the bottom of September 6th, 2024. And you can see that's cutting across, and now we broke that one, and we're also below this fib level as well, 3101. So in my opinion, we may actually drop down and test that level. Now in the short term, again, we've been volatile. So if we have another update, you could see a spike, maybe retest this trend line, try to retest this 20-day moving average. It can get back up to 33 and change, definitely. But then you may have a rejection and come back down, right? It may be a short-lived bounce, and then everything sells off again. So in my opinion, I'd say maybe like longer-term puts, actually. But this stock, as we see, hit almost $73, went up into uncharted waters. And now if we do something like that, you can see this is now our resistance trend line, right? So even if we bounce, look, it works out perfectly. If we touch up with the 20-day, if we touch up with this resistance trend line, about 33 1/4, 33 1/3, and then there'll be that potential rejection, and it'll come back down there, and then hopefully markets will be strong enough to bounce us back up and out and break up and above the previous levels that the stock just broke down through, right? But HIMS and HERS, in my opinion, I mean, back towards that high, $50, $60, in my opinion, I think easily. But again, it's possibly going to be in the long term, right? We may turn around June, July, markets are still volatile, markets are still red, right? So this may be a situation now where it may be actually very, very difficult to try to time and trade the short-term options. So, again, that's just my opinion. Obviously, if you're having success, I wish you the best of luck. But I just want everyone to understand, the risks involved and the volatility that could be coming. Even something like DraftKings, again, perfectly. I was talking about this in the Discord, expecting a bounce back here when the stock was at like 37, 38, and we were going to bounce back up to 40. That didn't happen. We ended up breaking the support level. We came basically right down to this trend line of about 36 1/3, and I even thought that now was the time to buy because it was going to, retest that trend line, get back to the 20-day, 38, grab some cheap calls, boom, in and out. And that didn't happen. As you see, it ended up closing below the trend line. And then today, we ended up gapping down almost 6%, essentially, in my eyes, what looks to be a retest of the lower, more quote-unquote realistic trend line, right? So now you're seeing this trend taking place with a lot of these smaller, up-and-coming growing stocks that we were looking at. HIMS and HERS, DraftKings, SoFi, right? You can see they're all kind of doing the same thing. And for reference, this is from the top of March 27th, 2024. And you can see I had one trend line going to that top. That's that one that it just broke. and I had the next trend line coming down across, touching that next top there, June 20th, 24. Touching those tops, and you can see, boom, that's where it cuts through right there. So we do have this fib. Again, there's a 1-year chart. So you have the fib right here at 32.29, where we could potentially see a little bit of a bounce. But if we are going to follow that trend, as I said, of retesting all of these stocks to their lower support trend lines, then chances are you may actually see about 31.60 here on DraftKings. But again, long term, the rate at which the stock is growing, I mean, to put even a $45, $50 price target on this, I think it's conservative. I mean, technically, of course, it could be viewed as overvalued, 16.5 billion market cap. The EPS has definitely been struggling the last couple of quarters, but look at that growth. Again, market share, increasing that footprint, signing more and more deals, right? They're the exclusive company, the exclusive brand of this and that, and, just constantly expanding their sports books and taking in more and more bets, right? And it's the volume that I said, in my opinion, that's going to help put the stock over the top. And you can see, again, just look at the growth over the last couple of years. Low 1 billion, 2.25 billion, 3.6 billion, 4.8 billion almost. I mean, we're talking about billions of dollars here, and the company is growing, 20, 30% in change year over year. It's definitely nothing to sneeze at. Yes, we're still operating at a loss, but you can see how that margin is increasing very, very nicely. And it looks like, again, even though it's for 2024, it was minus 10.6%, it looks as though if we could get above about 5.25, 5.5 billion, if we add these numbers up, we may potentially be net income positive. So that may help pump the stock up even more. And of course, even when we get updates from analysts, we can see, I mean, look at these numbers here. You got 35 analysts covering DraftKings, 27 giving it a strong buy, 1 giving it a buy, 7 giving it a hold. The lowest price target on record at the moment is $35. And again, average price target 58. You can see highest price target 75, right? We went over this when they reported earnings. Analysts come out, price target 55, price target 65, right? So they're looking for the growth to take place over about the next 12 to 18 months. They're expecting it to get back up here towards the highs. And in my opinion, I do agree. But again, we went on a big run. Markets were up 50% over the last couple of years. So now, if you bought near the high and everything's starting to cool off, unfortunately, now you kind of have one of two options. Either A, you bite the bullet and you take the loss, or B, you sit back, relax, and you wait for the entire markets to come back and rebound. So, a little bit of a sticky situation, but it happens to everybody. This is why, again, there are rules to investing. In my opinion, rules to follow, such as you should never put really more than like 10, 20% of your account value in one position. I say, personally, you should always have hedges in place, which I mentioned earlier. You should always diversify, right? And also, the main rule, you should always keep cash on hand. Situations like today, right? Imagine you had DraftKings at 50. Now you can see a big drop today, 6%, approaching a trend line, stocks back in the lower 30s, right? But if you went all in across your account, now you're screwed. Now you're just sitting there and waiting. So that's why a lot of people, try to follow these rules. But yeah, HIMS possibly down to 24. We just looked at DraftKings, and we'll look at SoFi again real quick. And you can see if I do extend this trend line of the original channel, right, perfectly, you can see, look, the body stopped right there and then bounced. That's why I love trend lines. But again, if in the short term, if we retrace to the 20-day, yeah, about 12 1/3, right? Then we may reject and we can come back down. You can see, look, now we're looking at about 10 1/4, possibly breaking, flash crashing to the fib at 985. Right? So that's why I was saying you could potentially see 10, maybe 9. So right here in the short term, believe me, I know it's stressful. But in the long term, a lot of these stocks that we said we liked, again, we kind of had the numbers to back it up. We have the growing businesses behind us to back it up and justify the theory of long-term growth on the horizon, right? But that's pretty much it. I know those were a couple of names that a lot of people are involved in, a lot of people trade, a lot of people watch, a lot of people obviously have positions in those companies. So I figured I'd jump on and just do some quick tech analysis for something like that. SoFi, in my opinion, might be the most undervalued. Got about a 13 billion market cap, 31 PE. Let's check the numbers real quick. Oh, and you can see, okay, debt cancels out cash, about minus $500 million. Equity has been growing to $6.5 billion, minus $500 million. You're at about $6 billion. And now we come here, and you can see we're at about $4.25 billion with revenue and profit. Plus $6 billion, right, brings us to about $10.25 billion. So that's what I mean. This stock, in my opinion, is only trading at about a 20% premium to my personal quote-unquote fair value. So that's why I think something like SoFi long-term should be fine. Something like DraftKings could be viewed as a little bit more speculative because technically the numbers may not look as healthy, right? The debt, though, I will say, has essentially been holding flat. Look at that, $1.34 billion for the last 4 or 5 quarters in a row. But something like the free cash flow up to $323 million. This time last year was 71. Right? Cash kind of bouncing around, but they're holding about $800 million cash on hand. But a lot of the fundamentals are improving. But if we did have to dissect a company, I would say probably, in my opinion, something like DraftKings could go down before it goes up quicker than something like a HIMS or a SoFi that looks healthier in the numbers, in my opinion. But as you see, debt here minus cash, we're at about minus $500 million. Short-term liabilities actually outweighing assets. If we come over here, we were at $1 billion equity, right? We came down to 800. We came back up, but we've been dropping technically for the last couple of quarters. So we're at $1 billion, so that minus $500 million, so that puts us at positive $500 million. Book value only $2.07, right? So we're trading, 16 times book. And if we come down here, we're at about $4.2 billion if we subtract the loss from the revenue, right? Plus that brings us to about $4.7 billion, in my opinion, quote unquote, fair value. Now look at the market cap, $16.5 billion, right? So if we're looking at a fair value to market cap comparison, DraftKings technically is the most overvalued out of these 3 names right now. Trading at, about 3.5 times fair value. Technically still operating at a loss. 3 PS misses of the last 4 quarters, right? So if one of those 3 names could continue to slip, it may be DraftKings, which is possibly why, even though we had a little bit of a steady kind of rebound today in the markets, that could be a reason why DraftKings just kind of dropped down and didn't do much. Prediction markets open the door. Nationwide sports betting. On track to dent betting companies. What's this? With about half of March Madness over, results aren't looking favorable to sports betting so maybe that's the reason why they chunked it down today. Again, March Madness, college basketball, right? It's usually very, very big. And again, I'm sure they're doing decent business, but as we know, we continuously try to up and increase our predictions. And if we fall short, that's when the stock takes a smack. Susquehanna analyst. March Madness, an important value driver this quarter. The first few days of the tournament were neutral for bookmakers, but Sunday's results were very unfavorable, with only 1 upset out of the 8 games played. Today it's likely we would have to trim our projections, but we'll wait for this weekend's outcome, as the Elite 8 and Final 4 rounds have yet to be completed. Expects quarter-to-date trends to be slightly unfavorable to neutral compared with expectations, right? So again, we see these companies even with the earnings, right? We consistently up a little bit, right? We're technically supposed to be growing quarter over quarter, year over year. So then, you get an update like this, and now all of a sudden we got to chunk the stock down because now we may not meet those expectations. However, I will say this. I know, again, they say the Elite 8, and now, of course, the Final 4, which eventually will lead to the championship. Though these now are the biggest handful of games, right? Everyone likes to get involved at the beginning. Maybe you got your brackets going in your office or whatever the heck. But as we both know, the cream rises to the top. And when you get down to these final 8 teams, the final 4, the final 2, that's when it gets very exciting. And in my opinion, that's probably where more bets are going to start flowing in. So I know this guy over at Susquehanna is possibly jumping in early, but again, I know they're looking at some of the figures, but in my opinion, I'd wait for March Madness to completely wrap up before I'd personally make that judgment. But technically, if that is what's going on and they're bringing in less than they thought, then again, I can understand why they chunked it down, especially if you have that catalyst mixed with potentially being overvalued, right? And what was the last one? HIMS. HIMS, if we look at the numbers, 6.5 billion market cap. EPS has been solid. We look last year, about 1.5 and change, 1.6 billion overall. And if we come over here, again, the one reason why I love this stock is essentially no debt, right? $11 million drop in the bucket. Look at the cash increasing like crazy. Free cash flow looking nice. Again, this time last year, 10.8 million. Last quarter, 59.5 million free cash flow. Cash on hand jumps up 165 million 2 quarters ago. As of last quarter, 220.5 million. Right? Very little debt, big cash on hand, fundamentals improving, revenue growing, margins growing, market share growing, footprint growing, right? So something like HIMS, in my opinion, phenomenal in the numbers. Very, very healthy. But we're sitting here plus 200 million. Assets heavily outweighing liabilities in both the short and the long term. Equity up to almost 476. So what, 200 million? So now we're at like 670. And then we come down here, 1.6 we'll say. So we're at 2.27 roughly. And market cap 6.5 billion. Right? So we're trading a little less than 3 times quote unquote fair value. So that's why I like to look at the numbers as well, because if markets do get volatile, you look at the healthiest financially sound stocks. And usually, in theory, those are the ones that hold up a little bit better. So technically, according to what we just looked at, DraftKings could be the biggest loser moving forward, have the biggest pullback, the biggest sell-off back to reality before bouncing. In second place might be HIMS. And in last place, in my opinion, according to the numbers, is SoFi. So if something like SoFi dips a little bit and then bounces and has a rebound quicker than compared to HIMS or DraftKings, it would technically make sense, as we just looked at how much more healthy their numbers are, right? But I just wanted to recap the numbers on those 3 stocks, go over some trend lines, and just point out a couple of things I'm looking at, because I know some people may have stepped in on calls, some people may have bought shares on a dip, and now they dipped even more. So just wanted to point out a couple of key levels as to where these stocks could go, and perhaps why they can go to those levels. But that's pretty much all I have to say, so I'll end it there. Once again, Stocks by the Numbers, I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But of course, more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, and they are very uncertain. So I do want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.